Investing can feel like navigating a vast ocean with its share of calm waters and sudden storms. Market corrections are one such storm, capable of sending shivers down even the most seasoned investor's spine. But fear not, for understanding these events is the first step towards weathering them successfully. Simply put, a market correction is a temporary decline in the stock market, typically characterized by a drop of 10% or more from its recent peak. Imagine a surfer riding a wave. Even the most experienced surfer encounters dips and troughs along the way. Similarly, market corrections are natural occurrences in the ebb and flow of market cycles. These corrections are not mere blips on the radar, they are significant events that can impact your investments. Understanding their nature, causes, and potential implications is essential for making informed investment decisions and safeguarding your financial well-being. Let's delve deeper into the world of market corrections, demystifying their complexities, and equipping you with the knowledge to navigate these turbulent waters with confidence. Much like a doctor diagnoses the root cause of an ailment, understanding the triggers behind market corrections is crucial for investors. These triggers can be as varied as the market itself, often stemming from a complex interplay of economic, geopolitical, and psychological factors. One common trigger is economic overheating, where rapid growth leads to inflation and forces central banks to raise interest rates. Think of it like a car engine revving too high. Eventually, it needs to cool down to avoid damage. Similarly, higher interest rates can curb inflation but may also slow down economic growth, impacting corporate profits and investor sentiment. Geopolitical events such as wars, political instability, or trade tensions can also send shockwaves through the market. These events create uncertainty, prompting investors to reassess their risk appetite and potentially pull back from the market. Imagine a flock of birds suddenly taking flight at the slightest disturbance. Similarly, market sentiment can shift rapidly in response to unexpected global events. Moreover, investor psychology plays a significant role in market corrections. Fear and panic can spread like wildfire, leading to herd behavior where investors sell off their holdings, further fueling the decline. This domino effect can exacerbate the correction, even if the initial trigger was relatively minor. Picture this: you're strapped in for a roller coaster ride. The climb is exhilarating, but the inevitable drops, while nerve-wracking, are part of the experience. Similarly, market corrections are an inherent part of the investment journey, and understanding their impact on your portfolio is crucial. When a correction hits, the value of your investments, particularly stocks, is likely to decline. This can be unsettling, especially if you're close to retirement or heavily invested in the market. It's important to remember that corrections are typically short-term events, and panicking can lead to poor investment decisions. Instead of viewing corrections as a disaster, consider them an opportunity to reassess your investment strategy and make adjustments if necessary. Perhaps your portfolio is overly concentrated in one sector or asset class. A correction can highlight the need for diversification. Moreover, market downturns can present buying opportunities for long-term investors. As stock prices fall, you can purchase shares at a discounted price, potentially boosting your returns in the long run. Remember, the key is to stay calm, avoid emotional decisions, and focus on your long-term financial goals. Section 4: Corrections versus bear markets, spotting the difference. While both market corrections and bear markets involve market declines, it's important to distinguish between these two beasts. Understanding their differences can help you react appropriately and avoid unnecessary panic. Think of a market correction as a sudden thunderstorm, intense but relatively short-lived. It's characterized by a drop of 10 to 20% from the market's peak and typically lasts for a few weeks or months. A bear market, on the other hand, is like a prolonged winter, a period of sustained pessimism and decline. It's defined by a drop of 20% or more from the peak and can last for several months or even years. Distinguishing between the two requires careful observation of market trends, economic indicators, and investor sentiment. While corrections are often triggered by specific events or short-term concerns, bear markets usually stem from deeper economic woes such as recessions or prolonged periods of high inflation. Knowing the difference is crucial for adjusting your investment strategy. During a correction, it might be wise to hold on to your investments or even buy more at a discount. However, a bear market might warrant a more cautious approach, such as shifting towards more conservative investments or holding higher cash reserves. Section 5, Navigating Market Turbulence, a guide for investors. Imagine yourself as a captain navigating a ship through a storm. You wouldn't abandon ship at the first sign of rough seas. Similarly, navigating market corrections requires a calm demeanor and a well-defined investment strategy. Avoid making impulsive decisions based on fear or panic. Market corrections are a normal part of the investment cycle. Revisit your investment plan and ensure it aligns with your risk tolerance. Consider rebalancing towards more conservative investments if needed. View market corrections as potential buying opportunities. Be fearful when others are greedy and greedy when others are fearful. Purchase quality assets at a discount to enhance long-term returns. Time, not timing, is your greatest ally in investing. Stay invested for the long haul to benefit from compounding. Section 6. Case in point, revisiting notable market corrections. History is replete with examples of market corrections, each offering valuable lessons for investors. The flash crash of May 6, 2010, saw the Dow Jones plunge nearly 1,000 points only to recover within the same day. Another example is the correction of late 2018, triggered by global growth concerns and trade tensions. These events highlight the interconnectedness of global markets and the importance of understanding market behavior. Section 7. The long view. Corrections as stepping stones to growth. Imagine a hiker climbing a mountain. The path is rarely a straight line upward. There are switchbacks, plateaus, and even the occasional descent. Similarly, the journey of an investor is marked by periods of growth, consolidation, and yes, even corrections. While market corrections can be unsettling in the short term, they are often necessary for long-term market health. Think of them as a pressure valve, releasing built-up excesses and paving the way for sustainable growth. Corrections can also present opportunities for astute investors to reassess their portfolios, rebalance their holdings, and capitalize on attractive valuations. The key to navigating these periods of volatility is to maintain a long-term perspective. Instead of panicking and making rash decisions, focus on your investment goals, stick to your strategy, and remember that time is your ally in the market. Ultimately, market corrections are not roadblocks but rather stepping stones on the path to financial success.